From the smallest company that exists to the world's largest population, every business needs cash. This chapter explores the management of that cash and the financial decisions organizations must make. To demonstrate the importance of this, think about Pfizer, which is a company that spends over $6 billion a year on research to develop new products, even though it takes as long as 10 years sometimes before the products are approved and introduced into the market. Since long-term funding is very critical in the business of pharmaceuticals, high-level managers are very involved in the finance decisions, which is also common at other companies. We'll explore this more in Chapter 18. The finance function is responsible for managing a scarce resource, which is capital, or in other words, money. Because of this, an important point to make is financial managers must understand accounting, and in fact, many of them have backgrounds in accounting, but they are not accountants in the company. They are decision makers and managers in the truest sense of the word. Often, next to the CEO, the Chief Financial Officer, known as the CFO, is the highest paid person within the organization. Finance activities include things such as preparing budgets, creating cash flow analysis, and planning for expenditures. In other words, planning for a firm's money needs and managing the allocation and spending of funds are the foundation of financial management, or finance as we know it. This slide demonstrates the importance of financial management to organizations. As you can see here, the top reasons firms fail financially include undercapitalization, which is a situation in which a business has insufficient funding or capital to support its operations. Another reason is poor cash flow control. This occurs when the incoming cash flow is insufficient to meet the outgoing cash flow needs of your business. Cash flow comes from your sales, interest income, capital contributions, and borrowed funds, which we'll explore more in this chapter as well as the next one. And finally, firms fail because they have inadequate expense control. This is why a budget, keeping track of income versus expenses, is so important, which we will also discuss more later. This slide sets the stage for what we will discuss in the remainder of the chapter. Successful financial management starts with a financial plan, which outlines the funds a firm will need for a certain period of time, along with the resources and intended uses of those funds. And the three key steps of financial planning are forecasting the firm's short-term and long-term financial needs, developing budgets to meet those needs, and establishing financial controls to see if the company is achieving its goals. Let's explore each of these over the next few slides. Forecasting is an important part of any firm's financial plan. A short-term forecast predicts revenues, costs, and expenses for a period of 1 year or less. A long-term forecast predicts revenues, costs, and expenses for a period longer than 1 year, and sometimes for as long as 5 or 10 years. The long-term financial forecast gives top managers, as well as operations managers, some sense of the income or profit potential of different strategic plans. It also helps in preparing company budgets. In addition to developing a financial plan and conducting short and long-term financing and forecasting, financial managers are responsible for developing a budget, which is a financial guide for a given period, usually a company's fiscal year. Like a good personal or household budget, a company's budget identifies where and when money will be spent throughout the year. Budgeting is critical for the organization to control expenses and to understand revenue expectations. It's good to think of a budget as a guidepost or a reference point for the organization's managers. The textbook talks about various types of budgets. For the purposes of this course, I want you to focus on capital budgets. A capital budget outlines expenditures for major purchases that require a large sum of money. Sometimes, depending on how large the purchase is, it might require planning over the course of multiple years as the company assembles the necessary funds. Now, let's look at financial control. This is a process in which a firm periodically compares its actual revenues, costs, and expenses with its budget. Financial controls also help reveal which specific accounts, departments, and people are varying from the financial plan. Most companies conduct a review of their finances at least once a month as a way to ensure financial control. One item to note is that shifts in the economy or unexpected global events, such as what we've seen and saw with the coronavirus, can also alter financial plans. Now let's look at debt financing versus equity financing. The most fundamental decision a company faces regarding financing is whether it will obtain funds by debt financing, which is borrowing money, or by equity financing, which is selling ownership in the company. To meet their changing needs over time, many firms use a combination of debt and equity financing, and many use several kinds of debt financing at the same time for different purposes. Note that business debt usually doesn't have the same negative connotations as consumer debt. Where consumers are advised to avoid most kinds of debt if at all possible, and being in debt is often a sign of financial trouble or financial management issues, robust and well-run businesses of all shapes and sizes use debt as a routine element of financial management. The key difference is that, unlike with nearly all consumer debt other than loans for education, businesses can make money by borrowing money. Of course, companies can also get into debt trouble through bad choices and bad luck, just as consumers can, and it's up to financial managers to make smart borrowing choices. Financing can be either short-term or long-term. Short-term financing is financing that will be repaid within a year, whereas long-term financing is financing that will be repaid in a period longer than 1 year. The primary purpose of short-term financing is to ensure that a company maintains its liquidity or its ability to meet financial obligations as they become due. By contrast, long-term financing is used to acquire long-term assets such as buildings, equipment, or to fund expansion via a number of growth options that companies consider. Trade credit is the most common form of financing. It occurs when suppliers provide goods and services to their customers without requiring immediate payment. Such transactions create the accounts receivable, as you've discussed in your accounting courses if you're a business major. From the buyer's perspective, trade credit allows a company to get the goods or services it needs without immediately disrupting its cash flow. Trade credit can also lower transaction costs for buyers, as well as the sellers, by consolidating multiple purchases into a single payment. In many cases, credit is extended at no interest for a short period of time, typically 30 days. I do want you to be familiar with how to read the terms of trade credit. As you can see here, 210 net 30 is a common way trade credit is written. What it means is that a firm can receive a 2% discount if the bill is paid within 10 days. If the company chooses not to take the discount, the net amount is due in 30 days. Secured loans are those that are backed by something of value, known as collateral, that may be seized by the lender in the event that the borrower fails to repay the loan. Common types of collateral include property, equipment, accounts receivable, inventories, and securities. Think about the example of a car with a car payment. If you don't make that car payment, that car is collateral, meaning that the organization that lent you the money for the car or the car dealership will come and take the car back. Unsecured loans, on the other hand, are ones that require no collateral. Instead, the lender relies on the general credit record and the earning power of the borrower. A common example of an unsecured loan is a line of credit, which is an agreed upon maximum amount of money a bank is willing to lend a business. Once a line of credit has been established, the business may obtain unsecured loans for any amount up to that limit. The key advantage of a line of credit over a regular loan is that interest, or at least full interest, is usually not charged on the untapped amount. Another advantage is that organizations do not need to constantly go and apply for a loan. They can instead draw from this line of credit. When businesses need a sizable amount of money for a short period of time, they can issue commercial paper. This is a short-term promissory note or a contractual agreement to repay a borrowed amount by a specific time with a specific interest rate. Commercial paper is usually sold only by major corporations with strong credit ratings in denominations of $100,000 or more, with maturities up to 270 days. This means that the amount needs to be repaid within 270 days or less. The commercial paper market is an important resource or source of funding for financially stable companies. During the financial crisis, which started in 2008, this important market completely shut down, forcing the Federal Reserve, which we will talk about in Chapter 20, to step in and assist many companies with their short-term financing by purchasing their commercial paper. In addition to the various short-term debt alternatives, a number of long-term debt financing options are also available. Corporate bonds are such an option. When a company needs to borrow a large sum of money, it may not be able to get the entire amount from a single source. Under such circumstances, it may try to borrow from many individual investors by issuing bond certificates that obligate the company to repay a certain sum plus interest to the bondholder on a specific date. Companies issue a variety of corporate bonds. Secured bonds, like secured loans, are backed by a company-owned property, such as equipment or buildings, that passes to the bondholders if the issuer doesn't pay the borrowed amount. Debentures, or unsecured bonds, are backed only by the corporation's promise to pay. Because they are riskier than other types of bonds, the companies that issue them must pay higher interest rates to attract buyers. To summarize, it is critical to understand that bonds are a form of debt issued by companies. The terms debt, bond, and loan are all four-letter words and basically mean the same thing. I also want to add that U.S. government bonds are considered the safest investment in the bond market. Some of you may be familiar with U.S. government savings bonds and may in fact have even received such a bond as a gift. In the next chapter, we will cover equity financing more in depth, but this concludes Chapter 18. Please let me know if you have any questions.